Welcome back to our series on climate investing for fund managers. In the previous video, we laid the groundwork by exploring what climate investing is and the various ways it addresses one of humanity's greatest challenges. Today, we are taking it one step further. We'll dive into the why. Why is investing in climate solutions not only for impact investors, but also one of the most exciting and lucrative opportunities in the modern investment landscape. So over the past decade, climate investing has shifted from a niche interest to a central strategy for investors worldwide. Consider this. In 2023, venture capital and private equity firms invested an astonishing $56 billion in companies offering climate solutions. That represented 10% of all private equity and venture capital investment globally, which is a massive leap from just 1.5% in 2013. This surge in interest is driven by more than just an impact imperative. Climate investing aligns with some of the strongest trends shaping the global economy, from policy shifts, technological innovation, evolving consumer preferences, and investor demand. As we'll see, this convergence is creating vast opportunities for financial returns while addressing urgent societal needs. By the end of this video, you'll understand the key drivers behind this growth, the market opportunities emerging across multiple sectors, and why climate investing isn't just about creating impact. It's about securing the future of portfolios in a rapidly changing world. Before we dive into the drivers and market opportunities, let's establish some foundational concepts. So first, what are climate solutions? So climate solutions are technology, products, and services that directly addresses the causes or the consequences of climate change. For instance, renewable energy installations, such as wind or solar farms, help avoid greenhouse gas emissions by replacing fossil fuels. Meanwhile, heat-resistant material, water gates, or early warning system can help manage the extreme events that we are facing and help communities adapt to the impacts of climate change. Together, these solutions encompass both mitigation, i.e. reducing greenhouse gas emissions, and adaptation solutions, which focuses on building resilience to climate shocks. Next, let's talk about market trends. These are patterns or tendencies in the economy that signal where future opportunities or challenges may lie. In the context of climate investing, trends include the rapid growth of electric vehicle adoptions, rising demand for energy-efficient housing, and increasing emphasis on decarbonizing and managing the climate impacts on supply chains. Lastly, let's clarify the roles of private equity and venture capital in climate investing. Both involve financing companies with high growth potential, but they focus on different stages of the company's business lifespan. Venture capital typically invests in startups developing breakthrough technologies, while private equity support more mature companies scaling established solutions. This form of financing have been instrumental in accelerating the growth of climate solutions, from energy storage technologies to climate-resilient agriculture. By understanding these concepts, you'll have the context that is required to appreciate why climate investing is growing at such an unprecedented pace.
Let's break down the factors fueling the rapid rise of climate investing. The first driver is the increasing impact of climate change. Climate-related disasters are becoming more frequent, more severe, and more costly. Over the last 50 years, weather-related disasters caused over $4 trillion in damages globally, with costs rising every decade. From devastating floods to prolonged droughts, these impacts are driving demand for solutions that mitigate risk and protect communities. For instance, think of coastal cities grappling with rising sea levels. Investment in seawalls, flood barriers, and green infrastructure offer not just protection, but significant opportunities for returns. Similarly, in agriculture, investments in climate insurance or water-efficient irrigation systems are helping farmers adapt to changing conditions while creating scalable business models. Next, consider policy and regulatory support. Most governments worldwide are taking decisive action to address climate change. As of 2023, nearly 150 countries have adopted or are considering net zero targets, setting the stage for widespread deployment of climate solutions. Policies like carbon pricing, renewable energy mandates, and subsidies for electric vehicles are accelerating growth in key markets, but this can vary by region. Take renewable energy as an example. Subsidies and tax incentives for solar and wind projects have driven significant cost reductions, making these technologies cheaper than fossil fuels in many locations. In transportation, government incentives and tax breaks for electric vehicles in countries like Kenya and India are fast-tracking the transition to electric mobility. Technological advancements are another critical factor. The cost of renewable energy has plummeted over the past decade, with solar and wind becoming some of the most cost-competitive energy sources globally. Meanwhile, innovations in energy storage, such as lithium-ion batteries, are addressing intermittency issues, enabling round-the-clock use of renewable power. Emerging technologies like carbon capture and storage, or CCS, are also gaining traction, offering solutions to decarbonize hard-to-abate sectors like steel and cement. For investors, these advancements create opportunities to support and scale transformative technologies. Then, there's consumer demand, which is reshaping entire industries. Today's consumers are more environmentally conscious than ever, driving demand for climate-friendly products and services. Electric vehicles are a standout example. In 2023, global EV sales surpassed 41 million vehicles, up from just 1 million in 2015. Similar trends are unfolding in energy-efficient appliances, plant-based foods, and even sustainable fashion. Finally, investor pressure is playing a growing role. Companies are being pushed to disclose their climate risks and align with recognized international frameworks. For institutional investors, climate considerations are becoming a baseline expectation. This dynamic is creating a virtuous cycle where the demand for climate solutions fuels innovation, which in turn drives further investment. Across all these drivers, the scale of opportunity is significant. According to the World Economic Forum, climate adaptation alone could represent a $2 trillion market by 2026. So, how can you begin tapping into this fast-growing market? The first step is to educate yourself on the climate-related risks and opportunities in your focus sectors. If you're in real estate, for example, explore how energy-efficient building designs or green roofs can reduce emissions and enhance resilience. If you're in agriculture, look at technologies like precision farming or climate-smart seeds. From there, develop a clear investment thesis. Decide whether you want to focus on mitigation, such as renewable energy projects, or adaptation, like climate-resilient infrastructure, or perhaps a mix of both. Align your thesis with global frameworks like the MDBs and IDFC's Common Principles for Climate Mitigation and Adaptation to ensure your investments contribute to meaningful impact. Collaboration is another critical step. Build partnerships with climate tech accelerators, incubators, and industry-specific coalitions. These groups provide access to emerging technologies, innovative startups, and curated deal flow. Finally, remember to look at both financial and impact metrics. Mitigation projects may measure success in terms of emissions reduced and removed, while adaptation solutions could focus on the number of people or value of assets made climate resilient. Tackling these metrics will ensure your investments deliver both returns and tangible outcomes.
Let's take a step back and reflect on what we've covered. Climate investing is being driven by powerful forces: the rising costs of climate impacts, policy and regulatory shifts, technological innovation, and evolving customer and investor expectations. The opportunities are broad, spanning sectors like energy, agriculture, transportation, and real estate. Renewable energy projects, electric mobility solutions, and sustainable agriculture are just a few examples of how climate investments are reshaping industries. What makes this space so compelling is its dual potential. Climate investing addresses one of the world's most urgent challenges while opening up high-growth markets. Whether you're mitigating emissions or building resilience, every investment contributes to a more sustainable and equitable future. As you think about your next steps, ask yourself, how can your expertise and capital align with the transition to a low-carbon, climate-resilient economy? Which sectors excite you most, and where can you have the greatest impact? We encourage you to explore climate investment opportunities in your area of focus. The Climate Investment Playbook is a fantastic resource to guide you, providing strategies, case studies, and tools to help you take action. Thank you for watching, and don't miss out the next videos in this series, where we will explore how to approach climate investing strategically. Remember, investing in climate solutions isn't just good for the planet, it's good for your portfolio too.